I'd like to thank everybody for joining me today. Today, I want to talk about irrevocable life insurance trusts and why they're still needed today, even if we have a large estate tax exemption and may not be doing it for estate tax planning. If you look at life insurance, how should it be owned? When we look at it, is it in your estate? Well, if it's in your estate, you know, it's there. The death benefit can inflate your estate values and looking at it, do you want it in your estate? And that's a question that we just need to look at. Does it, from an estate tax perspective, do we want it in? Do we want it out? If we want it out, then we need to do that from day one. But a bigger issue, since we have a large estate tax exemption, is how about creditor protection? Are your personally owned policies, are they exposed to your creditors, and are you okay with that? If we look at trust ownership, and that not only protects the current policy, but it protects the death benefit inside of the trust. So you're protecting the family away from your creditors, and you're protecting the family from their own creditors. So creditor protection is a big driving force for the irrevocable life insurance trust. The next thing I look at is the family distributions. Well, if you have a personally owned life insurance policy and you've named your kids as the beneficiaries, well, when they receive that, they're going to receive the lump sum distribution at your death. And not only is that subject to creditors, but now you can't control how that money's spent. So you start looking at, do we want to have a coordinated, broader plan? Do we want a trustee and a trust that directs how and when your beneficiaries are going to be using that money? Finally, you can maintain control after you're gone. So you're going to put in place that trust. You're going to decide who manages the principal and income of that trust. You're going to set the terms while you're competent, while you're alive, and you're going to give that guidance that outlives you. And you can have that set up for a trust that can last forever, or at least as long as there's principal in that trust to use. So make sure that ownership is a good decision, not just a default because you haven't looked at something better. When we look at this, and especially when we're looking at transfers into an irrevocable trust, it's a balancing act. The first thing we have to look at is what assets do we want to transfer to the trust? You've got to look at them. Does moving that asset out of your estate, does that match your goals? Both from a liquidity standpoint and a growth standpoint. So think about which assets belong in the trust and which ones don't belong in the trust. Then it's how much do you want to transfer? If you're just doing enough to fund the premiums, okay, you can do that on an annual basis. Or you can move large chunks of money, chunks of property, part of your business in using your exemptions, both the lifetime exemption and the annual exclusion exemption. You can use that efficiently and leave room in your estate planning for the rest of your life. So you want to make sure that how much you transfer matches in with your overall goals and planning objectives. Then we have to look up the step up in basis. If you've moved assets, appreciating assets into your irrevocable trust, well, you're not going to get a step up in basis at death. So we have to balance what we move into the capital gains issue. We're avoiding estate tax potentially, but are we, the trade-off, are we creating a capital gains problem that may have been more of a tax burden than the estate tax would be, especially with the high exemption? And finally, it's looking at if you're moving assets out of your estate into a trust, are you moving too much? We have to look at what are your lifetime needs, making sure that we look at the whole horizon lifetime for you and make sure that we're keeping enough in your estate to take care of you the rest of your life at whatever level and you want and having the assets available that you want. If we look at the irrevocable life insurance trust, it takes the policy out of the state, out of your estate, but with modern drafting, we can still give your family access during your life if we look at it. So out of the estate, that's the core benefit. When we talk about that, it's out of the estate, it's away from the estate tax, it's away from your creditors. There's a lot of good having the ILIT in place. The trust owns the policy, so it's outside of your estate now and when the death benefit pays out. When that death benefit pays out now, it's already going to be income tax free. Now we've moved it into the trust so that it's estate tax free. And we've shielded the proceeds from your creditors, and we've also shielded it from your beneficiaries' creditors. So it keeps that large asset from inflating your estate artificially. And artificially still is subject to an estate tax if it's there. But one of the problems that I come across is if we move that out of your estate, have we moved so much away that you as the owner of the policy, you've lost flexibility? Well, we can now with spousal lifetime access provisions, we can set up the trust so that your spouse can be the trustee of the trust. Your spouse can also be the primary beneficiary of the trust, which would allow the spouse to reach into that trust and access the cash value, access death benefit during their life. And so the spouse has access, the grantor of the trust and the insured of the life insurance policy cannot be the trustee and cannot be a beneficiary of this trust, but the spouse can be. So now we've got the ability for the spouse to have access to that trust during life. So this creates a nice way to create some additional flexibility in the planning, even though we're doing an irrevocable trust. So it's a nice add-on. If you look at the spousal lifetime access trust, this is an irrevocable life insurance trust that we've added the spouse and in as the beneficiary, potentially as the trustee, so that we can create additional access. So think about the grantor. This is the husband, sets up the trust. He is also the insured on the policy, and he's going to fund the trust with whatever gifts he wants to make to the trust. Spouse can then be the person that benefits from this policy. So now during life, the spouse and heirs can receive that benefit tax free during life. And then at death, that we've got the income and estate tax free on the life insurance policy. So a spousal lifetime access provision can really allow us to get it outside of the estate, but have that what if. What if you need more? The spouse can reach in during life and grab that. So one structure can create a lot of protection. And if we do it right, we can create a lot of value and flexibility there. When we're putting the trust together, I like to look at building your values into your trust, not just hey, let's set it up and make distributions, but what kind of incentives do you want to provide for your beneficiaries, your kids, your grandkids, whoever are going to benefit from this? Do you want to encourage them to work and you just say for every dollar that's earned, we'll give you a dollar from the trust? Or we can provide for education, starting businesses, buying first homes, charitable giving. All of these things are whatever's important to you. We can incentivize that into the trust distributions. Along with incentives, we can have disincentives. Think about these as guardrails on the distributions. If we have a beneficiary that has a drug addiction, well, we don't want to be distributing money to them that would create further problems with their addiction, but we could put them into rehab and protect those assets, the right way. So think about this. We're going to give the trustee discretion to make sure things that you don't want your money used for, that we protected against that. The other thing I look at when we're looking at setting up a trust is what state should we set it up in? Well, we can look at a state with good asset protection laws that protect the trust and allow us flexibility with the trust. And we can have favorable tax laws. So we go to a state like in Nevada, Wyoming, that have no state income tax. That way we've got a trust in a good tax jurisdiction. And we also get a state that has good administrative flexibility. So all of these things we want to look at when we're planning the trust so that it is all designed correctly in the right way. When we fund the trust, we have to look at it It's either going to be a gift or a loan. And all of these different things, we can use lifetime exemption, annual exclusions, family loans, third party loans. We can use other strategies like grants and sales to a defective trust. All of these strategies help us to fund the appropriate amount into the trust so we have the assets in the trust that we need. So I appreciate everybody getting on. If you have questions, reach out. If not, we'll talk again next week. Thank you.